Hi everyone, I am Kath and today we will be discussing about the Payment Industry 101, Fundamentals of Payment Processing System. What is payment processing? Payment processing is the series of actions that occur when digital payment transactions are initiated by a business. This includes everything from processing a card and opening secure gateways to communicating with issuing banks and consumer accounts. What are the benefits of payment processing? The benefits of payment processing are plentiful. For one, today's technology allows for these transactions to be quick and effective. Information is sent securely from merchant terminals to consumer banks and back in a matter of seconds. These systems manage all of the communication between issuing banks, credit card companies, and financial institutions. And they do it all without requiring the cashier to understand or to get involved in the process. Some of the different types of payments that are processed include number one, debit and credit cards. These are physical cards issued by banks permit holders to borrow funds in exchange for products or services. Number two is the digital wallets, software applications, typically on mobile devices that allow for electronic financial transactions. Number three is bank transfers, electronic fund transfers that typically occur between businesses. Number four, electronic checks, payment via paper checks converted into automated clearing house or ACH transactions. How payments are processed. Before exploring the different parts of payment processing, it's important to understand the process as a whole. Let's take a look at the higher level steps required for payment processing and then dive deeper into its components. To start with, a customer presents their card to a retailer either in person or online. The card data, including the cardholder's name and account number, is passed through the payment gateway, which then sends the details to the merchant's bank. The payment processor uses that information to notify the card's issuing bank of the transaction. Having been alerted of a transaction, the consumer's bank confirms whether there are sufficient funds available for the purchase to take place. At this point, the transaction is either approved or declined. In some cases, this is also the step where fraud is detected. When the payment is approved, the issuing bank lets the retailer know by communicating with the payment processor. The transaction is recorded, and every person involved, including the merchant and the consumer, is notified via the payment gateway. While this might sound complicated, we are going to take a closer look at what gateways and processors are. The key components to keep in mind are the gateways help transmit data, and processors are responsible for handling the transaction that results in a purchase. What are payment gateways? Payment gateways are pivotal to the process as a whole. A payment gateway is a service that links together all of the entities involved with a transaction and helps disparate systems communicate with one another. It comes into play at the start and end of a card transaction. In short, a payment gateway makes it possible for banks, merchant, and consumer to communicate with one another to make a transaction. Establish secure connections to transmit data between parties via encryption. Send card data to the payment processor for the transfer of funds. Inform the merchant and consumer when the payment is complete. Most point of sale or POS systems and card terminals have payment gateways built into their structure to streamline the components a business needs to manage. In addition, there are payment processors that offer gateway options for use. Now, what are payment processors? If gateways are the components that connect banks, processors are the entities that handle the actual logistics of those requests. A payment processor is a system that allows for transactions to happen between merchants and the consumer banks. As the name implies, it processes credit and debit card payments based on the request it receives through the gateway. Payment processors authenticate the transmittal information to confirm that it is valid with all the banks involved. The processor is responsible for the actual transfer of the funds, if approved, between the issuing bank of the consumer and the merchant account, the retailer. As a go-between for banks, merchants, and consumers, payment processors come in a wide variety and are designed to handle transaction fulfillment. They operate as a business themselves, using several different models through which they charge merchants for their services. Merchant accounts and process payments. Another component critical to the payment process is a merchant account. These are different from bank accounts and only used for credit or debit card processing. Merchant accounts act as holding areas for funds during the settlement of pending transactions. Merchant accounts come into play after a card payment is processed and funds are approved. From there, the money is transferred from the issuing bank to the merchant account for holding the processing. After 24 to 72 hours, the funds are then moved out of the merchant account and into the business bank account for access and use. Merchant accounts are an essential part of payment processing, but they also allow businesses added flexibility to accept recurring payments and subscriptions that require resubmission and holding. Security best practices for payment processing. Security remains a crucial part of every step in the payment process. Many systems come equipped with encrypted gateways to prevent data from being interpreted if it is inadvertently accessed. However, security is also to be implemented to other stages of the process and with good cost. Data breaches can be incredibly costly and cause harm to a business and its reputation. To avoid this, keep a couple of tips in mind. Look for a point of sale system that works with EMV chip cards. EMV stands for Europay, MasterCard, and Visa and refers to the microchips that are embedded in the front side of newer credit and debit cards, which the three companies created. These chips are designed to help protect against fraud since they can only be interpreted by specialized readers, limiting pathways for the theft and data fraud. Businesses can also familiarize themselves with the Payment Card Industry Data Security Standard or the PCI DSS. This information security standard is often required of merchants in order for them to conduct credit and debit card payment processing, guaranteeing a minimum level of security. These guidelines help inform what data should and should not be retained by a retailer during and after a transaction. Federal Reserve System. The Federal Reserve System is the central bank and monetary authority of the United States. It was created on December 23, 1973, with the enactment of the Federal Reserve Act after a series of financial panics led to the desire for central control of the monetary system in order to alleviate financial crises. The Fed works to provide the country with a safe, flexible, and stable monetary and financial system. The Federal Reserve System is composed of a board of 7 members, 12 regional Federal Reserve banks, and the Federal Open Market Committee. The Fed's main duties include conducting national monetary policy, supervising and regulating banks, maintaining financial stability, and providing banking services. There is a common misconception that the Federal Reserve System is privately owned. While its Board of Governors is a government agency, the regional Federal Reserve banks are set up like private corporations. What is the role of Federal Reserve in credit card processing? It establishes and enforces the rules regarding the acceptance and use of payment networks by its members. The Federal Reserve does not directly participate in credit card processing but sets regulations and rules for financial transactions, including credit card usage, ensuring security and stability in the financial system. Here are some important notes you should always remember. Who approves or declines the credit card authorization once the acquirer passes the authorization to the card network? It is the issuer. Typically, a bank or credit card company is responsible for approving or declining credit card transactions based on the cardholder's account status and credit worthiness. Who passes the authorization request to the card network once the merchant swipes the card through their terminal? It is the acquirer. Often a bank or payment processor forwards the transaction authorization request from the merchant to the appropriate card network. What is the definition of an independent sales organization or the ISO? They are the third party organizations or individuals that have relationships with the member banks and focus on the acquisition and management of merchants' accounts. ISOs work independently to sell and manage merchant accounts on behalf of acquiring banks, facilitating credit card transactions for businesses. Who sends the authorization code to the merchant once it's communicated to the card network? It is the acquirer. The acquirer receives the authorization code from the card network and relays it back to the merchant, completing the authorization process for the transaction. What role do processors play in the payment industry? They establish partnerships with acquiring banks to provide payment processing services to merchants. Processors handle the technical aspects of transaction processing, partnering with acquiring banks to ensure smooth and secure transactions between merchants and card networks. Do payment aggregators, also referred to as PayM, focus on manufacturing POS hardware? No, payment aggregators or PayFac focus on providing payment processing services to merchants, not on manufacturing POS hardware. Key events in bank card history and industry players. Understanding the historical milestones and key players in bank card processing is crucial for comprehending the modern payment industry. This lesson will cover significant events and the roles of various industry participants. A comprehensive look at the evolution of bank card processing, highlighting major developments and technological advancements that have shaped the industry. Here are the payment industry players. The successful processing of a payment transaction involves several different industry participants. Understanding the role of each participant is critical for grasping the overall payment ecosystem. Number one is the consumers. Consumers are individuals who use various payment methods to purchase goods and services from merchants. These methods include checks, credit or debit cards issued by banks, prepaid cards, and cash. What are their importance? Consumers drive the demand for payment services and are the end users of the financial products offered by issuing banks and other payment providers. Number two is the merchants. Merchants sell products and services to consumers and accept multiple payment types in exchange. Their transaction environments include card present, brick and mortar stores, card not present, e-commerce websites, electronic mail, phone transactions, unattended settings like kiosks, self-service dispensaries. Merchants facilitate the exchange of goods and services for payment, playing a crucial role in the transaction process by integrating various payment methods. Number three is the issuing bank or the issuer. Issuing banks provide financial services such as savings accounts, loans, and credit card issuance. They promote their payment cards, charge fees by interchange and interest on card balances, authorize or decline purchases, and bill card holders and collect funds. The types of cards they issued were credit cards, allow purchases on credit to be paid later with interest. Then debit cards provide electronic access to bank accounts with immediate fund extraction. And lastly, the prepaid cards hold value on the card itself and can be reloadable. Remember, issuers are responsible for providing and managing payment cards, handling authorization, and maintaining customer accounts. Number four is the payment networks. Organizations like Visa, MasterCard, American Express, PayPal, NACHA, Star, and Gianni. They establish and enforce network rules, partner with issuing and acquiring banks for transaction processing, collect interchange and assessment fees. Payment networks ensure secure and efficient transaction processing, maintaining the infrastructure and rules of card usage. Number five is the acquiring bank. Acquiring banks play a critical role in the transaction process by working directly with merchants. They are responsible for providing merchants with the ability to accept credit and debit card payments, managing merchant accounts, processing transactions received from merchants, ensuring the funds are transferred from the issuing bank to the merchant's account. They also have these functions: merchant services, transaction processing, and risk management. In the merchant services, acquiring banks offer various services to merchants, including payment terminals, payment gateways for online transactions, and fraud prevention tools. In the transaction processing, they handle the authorization, capture, and settlement of transactions. And in risk management, acquirers assume some of the risks associated with processing payments such as chargebacks and fraud. Acquiring banks are essential for enabling merchants to accept card payments, providing the infrastructure and services needed to process transactions efficiently and securely. Number six is the processor or the aggregators. Processors and aggregators are the backbone of the payment processing industry, handling the technical and operational aspects of transactions. Their functions are as follows: transaction routing. They route transactions from the merchant to the acquiring bank and then to the issuing bank. Authorization and settlement. Processors manage the authorization of transactions and ensure that the settlements are completed accurately and on time. Data security. They implement security measures to protect transaction data and comply with industry standards such as PCI DSS or the Payment Card Industry Data Security Standard. Examples: processors, companies like First Data, Fiserv, and WorldPay are well-known processors that provide these services to merchants and acquiring banks. For the aggregators, like PayPal and Stripe, are examples of aggregators that allow merchants to accept payments without needing their own merchant account. Processors and aggregators ensure that transactions are processed smoothly, securely, and efficiently, enabling merchants to focus on their core business activities. Number seven is the Federal Reserve. The Federal Reserve, as the central bank of the United States, plays an indirect yet crucial role in the payment processing ecosystem. Its functions are as follows: batch settlements. The Federal Reserve facilitates the settlement of batch transactions, ensuring that funds are accurately transferred from issuing banks to acquiring banks. Regulation and oversight. It sets monetary policy, regulates banks, and ensures that stability and security of the financial system. Clearing and settlement services. Through its automated clearinghouse, or the ACH, and Fedwire services, the Federal Reserve provides infrastructure for the electronic transfer of funds. The Federal Reserve's role in settlement and regulation ensures the stability and reliability of the payment processing system, maintaining trust in the financial system. Now, here is the credit card authorization workflow. Number one, cardholder initiates transaction. The cardholder issues or uses their card at the merchant's POS terminal or enters card details online. Number two, merchant sends request. The POS system or payment gateway sends the authorization request to the acquirer. Number three, acquirer processes request. The acquirer forwards the request to the appropriate card network like Visa and MasterCard. The number four, card network routes request. The card network routes the request to the issuing bank. The number five, issuer approves or declines. The issuing bank verifies the cardholder's account and available credit or funds. The issuer sends an approval or decline message back through the network. Number six, acquirer informs merchant. The acquirer receives the response and informs the merchant. Number seven, merchant completes transaction. If approved, the merchant completes the sale and provides goods or services to the cardholder. Now, here are the settlement and dispute resolution mechanisms. For fraud prevention measures, card verification value, or the CVV. The CVV is used during the authorization process to verify that the card is physically present with the cardholder. Address Verification Service, or the AVS. AVS checks the billing process or address provided by the cardholder against the address on file with the issuing bank. Then real-time fraud detection. Many processors and issuers use real-time fraud detection systems to identify and block suspicious transactions. In handling declined transactions, decline codes. Issuers provide specific decline codes indicating the reason for a declined transaction, such as insufficient funds, incorrect card details, or suspected fraud. Then customer communication. Merchants and PayFacs often have procedures in place to inform customers of declined transactions and suggest corrective actions, such as using an alternative payment method. Fraud prevention measures and efficient handling of declined transactions are critical for maintaining security and customer trust in the payment processing industry. Interchange fees. Interchange fees are charged by the issuing bank to the acquiring bank for each transaction. These fees compensate the issuer for handling transaction risks and providing card services. Interchange fees typically include a percentage of the transaction amount plus a fixed fee per transaction. Then in settlement timing, end of day settlement. Many merchants settle transactions at the end of each business day, ensuring timely transfer of funds. In real-time settlement, some payment processors offer real-time or near real-time settlement options for faster fund transfers. Dispute resolution. We have chargebacks and merchant response. In the chargebacks, customers can dispute transactions through a chargeback process if they believe a transaction is unauthorized or incorrect. And in merchant response, merchants must respond to chargeback requests by providing evidence to support the legitimacy of the transaction. Understanding the components and timing of settlement as well as effective dispute resolution mechanisms, is essential for maintaining smooth and reliable payment processing. Overall, this extensive exploration of the payment processing industry highlights the critical roles and functions of various components, from settlement and reconciliation to the impact of blockchain and open banking. Understanding these elements provides a comprehensive view of the complexities and interdependencies within the payment ecosystem. This knowledge is essential for navigating the industry, ensuring secure and efficient transactions, and driving innovation and growth in the global financial landscape. That ends the discussion for today, and thank you and have a nice day.